the article that is coming. That's what at least one financial expert is saying. Charles Brown of CB3 Financial says,
one of the brilliant moves that Kmart has done is to partnership with Facebook in these e-gift certificates, so you can actually...
Of government mismanagement. Charles Brown is the president of CB3 Financial Group. He joins us this morning from Chicago.
Significantly dropping. Basically, this is the year of the consumer.
Believe that they're capable of managing anything?
Well, it's sort of like handing the keys to the chicken coop to two wolves.
Good evening, everyone, from Chicago. It's Thursday, June 25th, and I'm your host, Charles Brown, Portfolio Manager with CB3 Financial Group. We are so glad you have joined us tonight. It's going to be a great show with a very special guest in just a few minutes. From COVID to clarity, this is CB3 Live. Let's get to tonight's top three. Coronavirus cases continue rising in many key U.S. states, and these are big states. A deceleration in market bullishness, but actually it picked up again today as the coronavirus cases reaccelerate. So as the coronavirus accelerates, the market kind of went into a deacceleration mode. But again, that got corrected here at the end of the day. And then we're going to look at the bull case, bear case. This time, instead of individual stocks, we're going to look at sectors. Okay? So here we go. Without a doubt, coronavirus back in the news. The simple graph I have for you here is that the positive test rate is rising. From the 15th of this month, it has spiked definitely, and this is not a good sign, especially because we were told, or at least the medical authorities told us, that we might see an ebbing of cases here in the summer months. Well, that has not been the case. If you saw this graph last week, you might remember that the moving average of reported cases had started to turn up. Well, now it has decidedly turned up, but there is a silver lining, and that's because the death cases are not moving up, okay? Or they're slightly moving up. To be totally accurate here, you see that little bump there in the moving average. But for the most part, we're seeing an increase in cases. These are in the larger states where, candidly, social distancing is not being practiced. And the bump in death cases, at least as of this week, is not yet alerting. Still not good news, though. These cases are mounting in states like Florida, Texas, Arizona. And again, what I said earlier, it looked like the medical authorities were telling us that, well, when the weather turns warmer, that ought to perish COVID-19. That is not happening at all, which just goes to show that every variety of a flu that comes along behaves differently. It doesn't look to us for guidance. So these big states and these southern states, they have not been immune at all. In fact, if you look at the chart here, Arizona, South Carolina, Florida. Now, Utah is kind of strange. There's only one major population center there. Mississippi, Texas, Nevada, Georgia, Alabama. Mostly southern states where, again, I would have expected that this would have been more prevalent in the northern states where, even though it's warm here in Chicago, it's not nearly as warm as it is in Atlanta, Florida, Texas. But that's just not how the disease is behaving. So that's the stats. You can see the national average there in the black line. Now, on this graph, there's a ton of stuff to see, but here's what I want to point out to you. I've never shown this graph before. I really like it. The blue are the counties that are in the top 20 for an increase in unemployment. The orange is a 20% increase for deaths, and the purple is a 20% increase for both unemployment and deaths. That's really bad. So wherever you see purple on this map, and it's scattered all over the U.S., those are really high concern areas. You can see there is no purple in Georgia, or at least very little. Georgia is still the benchmark because they were the first state to reopen. But what it looks like right now is the reopening at least some of the population centers have not followed the social distancing, social physical distancing, and that is what is causing this. I hope people will change their behaviors. You've seen this graph in variations over the last 5 weeks, but look at this spike in Sweden. This is deaths. This isn't cases. I've been showing you cases comparing how Scandinavia is, Finland versus, and of course, that's really Nordia, but Denmark and Norway and Sweden. Well, Sweden by far and away is the worst, and again, because they didn't follow the practices that the World Health Organization recommended. The social distancing, they got the economy opened up with literally within a few weeks of when it was declared a national pandemic, and you can see that that strategy has colossally failed. We are seeing people returning, and you've seen variations on this graph over the last few weeks. South Carolina, Texas, the U.S. in general, Arizona, Florida, the spike goes down there in March, and now shopping centers, restaurants, recreation locations, etc. People are going back, but it is flattening out. You see the flattening? We didn't have that last week, and that's because of the case increase. Again, you probably can't see all the words on this graph, but the important thing is the colors. Where there is a dark blue, that is where the biggest rise is in cases that is affecting restaurant business. And as many of you know, maybe in your particular state, you've been able to eat out on the street. In our city, here in Glen Ellen, which is a suburb of Chicago, they closed down Main Street with concrete barricades. And they are allowing people to eat out there. We were even there last week, but that's being shut down. Atlanta, Alabama, Georgia, Florida, Texas, a lot of southern states. This virus is very unusual in that it has done nothing but increase in the hot weather rather than decrease. So what you're seeing here, employees in small businesses, while there was a huge recovery the last 2 to 3 weeks that I've been bringing my program to you, that has flattened and now started to turn over as the number of cases has increased. What we don't know is this an aberration? Is this the start of a new trend down? The market is not responding negatively, and we'll talk about that obviously later in the program. What you see here on the map are the number of countries, the locations in the world where you cannot travel. South America, almost all of Africa and the Middle East, literally shut down and still not allowing traffic in and out. China has partially restrictive, the U.S., Australia, New Zealand. I expect this map to change every week. But the reality is, as these cases increase, you're starting now, even just I think it was 24 or 48 hours ago, that New York is requiring a 14-day sequestering if you fly into their state from one of the high-risk states, which are in the South. So it's still a very much moving picture, which is why I continue to do these weekly broadcasts for you. So here's some good news. And this literally just affected us this afternoon. Alice and I used to have the groceries delivered outside our door. We'd let them sit there and let the germs get off of them, so to speak. I'm laughing at us, and I shouldn't do that. And then we would take Lysol wraps and wrap on, wipe down the bags, take the bags and leave them in the hall, and then bring the food in. Well, there is no evidence, says the USDA and the FDA, no evidence that you can contract COVID-19 from food or food packaging. And that to me is encouraging. So it pretty much means stay 6 to 8 feet away and wear your mask. I don't know why that's so tough for some places to do that, but we're still seeing great progress. Globally, there are more than 100 vaccines that are under development, with 9 of them in human clinical trials, not with rats, but humans, okay? I expect to see more companies entering phase 1. We've talked about Moderna. That was last week. They're already well into stage 3. So there is a race going on in healthcare. Healthcare will come into play later in this program, okay? This is an interesting graph. I've never shown you this one either. So look at January 31st to June 12th. That's the latest data that I have. And it shows you which areas of the economy have made the most progress and the least progress. So the financial sector is in gray, and that's way up at the top, followed by mobility, meaning people's willingness to drive, to take trains, to go for walks, production, employment. At the very bottom, okay, health, obviously, and that's spiked up again because of what people are calling wave 2. Someone said on Bloomberg today, actually I call them Gloomberg, let me get that right. How can you start phase 2 when we really never finished phase 1? I think candidly they have to go back and rewrite the history books as to when phase 2 started, okay, or when phase 1 ended. We're really not going to know until we look back. So I showed you this slide last week. I want to do it again this week because it is so important. Here's the good news. And yes, I didn't stutter. Here is the good news. We're in a recession. We're in a recession. Why is that good news? Because we no longer have to worry about entering a recession. We're in one. It's okay. We're going to be fine. Every single recession in history ends with an economic boom. What we don't know is the length of time. And there's going to be a quiz later in our program for you guys to participate in that, okay? So, for our first question, I'll check the board here. Did this week's continuing COVID second wave news make you feel anxious this week? We had a similar question last week, but I want to know what your answer is. So A is no, though I still think a significant case rise will occur. That's a different answer from last week. So you're not concerned, even though there's probably going to be a rise. Yes, it will be a major second wave. C, second wave, yes. Shutdown, no. And of course, that's what everybody is concerned about from an economic point of view. If we have to have a second wave, do we have to have a second shutdown? I don't think it's going to happen, but there's your chance to vote. Or D, not sure what you think. Because we've got about a 20-second delay, you guys read this, answer. I'm going to check the message board here. All right. Thomas, nice to see the market end on a plus after the pandemic threatening. Yes, agreed. It was a great finish. Hi, Nellie. Welcome to the show. Happy birthday. Young people are testing positive. That is true. And young people are testing positive in southern states. I don't get it. They just won't stay away from each other. Wear a mask. Do something. Okay. We got an A from Nellie. We got a D. Okay. Thomas. Okay. That's a different answer than last week. Alice got an A. Pandemic in LG is blowing up all around the lake shore, and that's probably because so many people are down there eating at Popeyes. Hey, Mark. Good to be back from your travels. Mark Burns. Jimmy, welcome, buddy. We got a bunch of answers. Greg, okay, you think it'll be a major second wave? We'll see, Greg. I hope not, but could be. Don says second wave, yes. Shutdown, no. Okay. Karen. Hey, welcome, Karen. Yeah, I was a bit anxious. All of us. Hey, Martha up in Michigan. Got an A. No, won't be significant. All right. Hey, Dave. Good to see you. Dave Roos. Just spikes, not a second wave. Yeah, so you're kind of in the C camp there. First wave for Southern. Thanks, Chris. Welcome to the show, Chris. Guys, thanks for those answers. All right. So let's stay optimistic. And the best way I could think to stay optimistic is introduce to you my guest for tonight. I'm thrilled to have Leo Kleinstein, VP of Engineering and R&D at Duquesne. Duquesne is a manufacturing firm here in the greater Chicago area. And Leo is one of the main dudes out there. I mean, this guy, look at this resume. He's been there for 20 years. Leo came to this country from Russia. He has completely revamped their product line for ultrasonic welders, vibration welders, spin welders, laser welders, as well as other Duquesne products. And he has authored or co-authored 20 international and U.S. patents. Super impressed. And what I'm interested to hear from Leo is our listeners want to stay optimistic. And Duquesne has an incredible story. So I would like you guys to welcome with me Leo Kleinstein from Duquesne. How are you, sir?
Very good. Good evening, Charles. Good evening, everybody.
Thank you. It's so good to have you here on CB3 Live. So in a time when so many companies are laying off workers, what has made Duquesne, Leo, the business success that it is, and why should our listeners be encouraged by Duquesne's success? I think it's a great story. Tell us why.
Well, counterintuitively, perhaps the fact that we're located in the United States actually contributed to our success. We were able to meet the increased demand for PPE, personal protective equipment, for mask manufacturing, which was a very significant increase in our business just to meet the demand in China, in the United States, and all over the world. And we were able to deliver fast. We were able to meet the challenges with alterations to our supply chain, make quick engineering changes, innovate on the fly, and being innovative and being quick. Being quick was more important than being big.
Oh, I bet.
We were able to gain a lot of business due to that.
So we've been reporting all kinds of statistics, and even today there's another 1.7 million unemployment claims. Is Duquesne hiring or expanding your territory, or just sort of even keel? Because we've talked on and off over these last few weeks where you said, hey, we're having, I think, your best year ever or your best quarter ever, some phenomenal statistic. Why are you guys that successful when everybody else is struggling?
Well, I mean, we turned lemons into lemonade, if you will. COVID is a terrible pandemic that happened to the globe, essentially, to our world community. But we were able to come up with the solutions in these challenging times and deliver products that were in demand, in these challenging times. We have not laid off a single employee. Several people left through attrition. Basically a retirement, moving to other locations, and we're replacing these few individuals that left. But we also have a global footprint. So only about 45 to 50% of our workforce is employed in the United States. The rest of our employees are in all major manufacturing areas of the world. Europe, China, India, Mexico, and so on.
I hate to ask you to repeat yourself, but that's just such great news. I don't want my listeners to miss that. The world is seeing the U.S., let's forget the world right now, just the U.S., seeing a spike in unemployment to 30%. Duquesne has not only not laid off a single person, I think you just said, but when people leave with attrition, you are rehiring to fill that slot. Is that correct?
That is absolutely correct, yes.
That's a fantastic story. So what happens if there's a second wave? Obviously, we talked about this last week. It's all in the news, the second wave. As I mentioned earlier, we're not even sure we're done with the first wave. What are any contingencies that Duquesne has for your business plan if there is a second wave of COVID-19?
First of all, we are still operating with a reduced on-site presence. Most of our office employees are working remotely from their homes. And the purpose is to keep our production staff safe and secure to maintain the production and deliveries. Only those engineers who have reason to be in the plant visit the plant for a day or two to help with production, or sometimes to help with even manufacturing functions. In order to meet delivery demands, when we were short on certain components, my engineers volunteered to basically make those components by hand.
Oh, wow.
Not waiting for delivery from some plant overseas that was shut down because of the COVID. So we are trying to be preemptive. In the building, everybody is wearing a mask unless you're in your private office.
Sure.
We are also reconfiguring the building. It's a very large property in St. Charles, and there are other tenants in that property. So we're reconfiguring the building to minimize interaction with our neighbors and streamline the traffic. Just trying to be common sense and proactive. And if something changes, we'll have a plan B or plan C. We're not giving up.
That's great. So when we were in the green room, Leo and I were talking while you guys were watching the roll down, and Leo said, I'm working from home, but I'm working harder than I have in 40 years. So let's make sure our listeners understand. It's not like you guys are just making do and you haven't laid anybody off, but you're just barely hanging on. You literally have so much work you can barely handle it. Is that what I understood in the green room when we talked?
That is absolutely correct, Chuck. Basically, I almost never work from home in my, as you said, 41 years of my engineering career. And what is happening now is not entertainment. It's not a vacation. Yes, my commute is very short, but overall hours are up and the intensity is up. At Duquesne, we always pull together when the times are tough, and we have a very loyal team of very dedicated people in all functions of our company: management, production, engineering, sales team, application, and we just get tough. Times get tough, we get tougher.
That's great.
Big deal. We'll ride it out.
So my last question for you is, I know in addition to being an ace engineer, you're also a pretty astute investor. You immigrated here from Russia years ago. You've been involved in the market. Were you scared out of the market during this move, or what is your thought? What's your recommendation, if you want? You can't really make a recommendation, but what's your advice for people that are concerned? I mean, you're on the front line with this company, and I know that you have substantial assets in the market too.
Correct. First of all, we all know, we're all adults, and we know that the market cannot keep going up forever. So if there is a silver lining in the current situation, I almost take it as a blessing. We all have been waiting for that correction, recession, what have you. So COVID forced it. Probably the market would have been going up for another year or two, but at some point it was due for correction. So
sure.
Let's take correction with COVID, and good things will happen. You all know that the news with the high tech, for instance, those of you who read articles on the subject, you notice that there was an incredible increase in success numbers and financial data from high tech company, mostly communications, all the big names.
Sure.
And part of it is because COVID has forced people to change their purchasing habits. It was underway, but otherwise it probably would have lasted another 5-7 years to reach the point of e-commerce, which was forced on us, and it happened in 3.5 months. So I believe in American ingenuity. I believe in American businesses. People will believe in American people. With all this silliness that's happening around us, I'm still optimistic, and I'm sure that we'll find our way out of this predicament.
Oh, I'm sure we will. I'm going to just give you guys 20 seconds to send some questions in. If anybody has a question for Leo, again, Leo's Vice President in charge of engineering at Duquesne here in St. Charles. For those of you out of town, that's a suburb west of Chicago. He's been doing this for many, many years. He's got numerous patents to his name. And if you've got any questions about the manufacturing sector, I mean, people say that manufacturing's all been taken overseas. That's just not true. Now, Duquesne does have more employees, as you've just heard, overseas than in the U.S., but they have a huge base here in the U.S. as well. So anybody have any questions for Leo? Again, I know we're on a delay, so I'll wait for a few seconds. If not, we'll let Leo go. But that was awesome, Leo. I mean, I'm all about optimism. That's the reason I wanted to have you as a guest, because I knew that you had a great story, and then you also had a great demeanor about it. And we need to hear this. We need to hear this when the cases are rising in the South, and they're shutting down. Disney's now put off their reopening for 3 more weeks. It gets people freaked out. So, giving you guys just a few more seconds on questions. If not, we will move forward. Great guess, says Tommy. Keep them coming. We will. Okay, Tommy says great guess, Leo.
All right,
Guys,
thank you, Tommy.
thank you. And okay, here we go. Here's a question from Nellie. Do you think more companies will bring their manufacturing back to the U.S., Leo?
I'm pretty sure that is the case. It will not be everything, coming back. What I foresee is value added and critical supply, like medical related, all kinds of materials that are critical for defense and healthcare, are likely to come back to U.S. I also expect a very large number of more mainstream products, if you will, mid-level, to go to Mexico. In my opinion, I can see it today.
Okay.
Mexico is next China with regards to manufacturing. It's close by. We're in the same time zone. The culture is fairly better understandable. There is a lot less language barrier. We already have tremendous trade relationship. So that's what I'm expecting. And we at Duquesne we have had employees in Mexico forever, but we have opened official office 2 years ago, and we see this as a tremendous success, and we will be putting more effort in Mexico as well.
That's great. We got time for one more here from Kate in Montana. How many employees does Duquesne have in engineering versus manufacturing? Good question, Kate.
Yes, we have an unusual high percentage of engineering. We are kind of very heavy on technology. So in St. Charles, which is our headquarters, I have about 60 engineers, and there are probably less than 100 people in manufacturing, maybe 100 people in manufacturing.
Gotcha. Leo, thank you so much. We got a lot out of this. We really appreciate it. Wishing you the best and Duquesne the very best.
Thank you.
Take care. Bye-bye. All righty, guys, let's look at the U.S. economy. Economy very closely tied to COVID-19 right now. NASDAQ up 10.5. S&P, Dow, and Russell still down for the year. This is almost unchanged from a week ago. Just so you know, almost unchanged from a week ago. Why? Investors are still sitting on a huge pile of cash. So I showed you this one last week, but I need this one on the screen to set you up for this one. What we're seeing is an enormous change in the savings rate. Look at this, 1960, 1970, 1980. There's the percentage of savings versus disposable income, and it spikes to 33% in April because people are scared. All right. Not only are people scared, this is financial companies. What are companies doing on their balance sheet? They are raising cash in the first quarter. Okay. So the banks are doing the same thing. Do you see the spike there in the blue bars? Yeah, the spike in the blue bars is crazy. All right. Cash is being raised. So here's my question for you guys. What is the significance of all these entities going to cash? A, they're smart to hoard cash. B, those in cash have missed a huge market move off the lows of March 23rd. C, a little cash hoarding is okay for me. Or D, not sure what to think about it. Well, what's your answer, guys? I know there's about a 20-second delay here, so you guys go ahead and answer. And then we'll keep going. What's the significance of all these entities going to cash in 2020? All right. Anybody? I'm waiting for the delay to finish up here. They're smart to hoard cash, says Tommy. Okay, anybody else? Anybody else? A little cash hoarding is okay. Okay, Mark. Nellie, not sure what to think about it. Okay. Greg Buffington, little cash hoarding, good. Yeah. Those in cash have missed a huge market move. That is true. Karen, C, good. Cash is king, Chris. Well, except that if you're all in cash, you just missed about a 52% move in the NASDAQ. So Cash gives you options, I suppose. All of that's true, guys. Thanks for thinking, Martha A. Okay. Got it. Guys, that's what we're trying to do in this segment. Keep people thinking. So we're going to talk about the percentage of the S&P 500 that is in the 6 largest companies. Many of you have heard the acronym FANG, F-A-N-G. Well, that's been added on to, so it's F-A-A-N-G-M. It's, I see, Martha, you're changing to B. Okay. Yeah, at worst, you still have your money, Chris, but yeah. We'll be talking about this over time, guys. With this delay, it's kind of tough on these questions here. But the reality is there's a huge move. If people sold out on March 23rd, they just lost, a 50% up move in the NASDAQ and likely at least 40% in their portfolios. So Facebook, Amazon, Apple, Netflix, Google, technically Alphabet, but that would make 3 A's, and M for Microsoft. What is the percentage of the S&P 500? Look at that since 2013 and the enormous move that's made. So what does that mean? On this chart, again, it doesn't matter if you see all the numbers. As of the 19th, which is just 6 days ago, FAANGM, the 6 largest companies in America, are 24% of the S&P 500. So this scares some people because they say, oh, until the rest of the market catches up, this is just an aberration. Well, the problem with that mindset is you're assuming that Apple cannot go to be a $2 trillion company, or that Microsoft cannot become a $2 trillion company, and that somehow companies like GE and 3M and Abbott Labs are going to catch up and become $1 trillion companies. There's no indication that that's going to happen because they're not bringing that much new technology to the market, with the possible exception of the medical stuff. I want to keep bringing good news to you. Durable goods increased in May, 15.8%. Clear takeaway is that order activity, this is at the industrial level, not the consumer level, rebounded even though it's lower from a year ago. Since the first episode, I've been telling you, we're not looking for absolute data to be blow away here. We're looking for relative data versus what it could be if we were not having a recovery. So very important to differentiate between the two. New family homes, you've seen this a few weeks ago. Look at the spike continuing at the very edge of the chart there, that blue line. You can't see the data on here, but just look at the trajectory of the line. This has to do with real estate, housing market index coming back, sales activity coming back, buyer traffic. That means people kicking the tires, looking to buy a home, even if they haven't closed. Sales expectations. This is from the National Association of Home Builders. This is a very positive chart. Good to see that. Home furnishings. Normally, they're not even on the chart here. They don't even rank. You can see all the little blobs that nothing happens for 2 years, and then all of a sudden out of nowhere they plummet, and then they turn around and have a huge comeback in early June. It's just really great to see this data, folks. This is the real thing. We have an update on retail sales from last week when I told you about the blowout numbers from May. The bar continues to move up. There's a little bit of a turn down here in the S&P real estate composite. But that depends on if you look at the big box houses by themselves or if you add them into the brick and mortar companies. Basically, total retail sales increasing is such a huge positive when we continue to see so much negative information in the news. I mean, this to me is an unbelievably resilient market. We may not be at the lifetime highs, but we're within 3 or 4% of it. The NASDAQ, of course, has exceeded the February highs. The S&P, the Dow, and the Russell are waiting to catch up. All right. I think it's going to happen. Either that or the NASDAQ's going to drop back down because the other indices were, quote, right. I don't believe it. I believe that they will catch up with the NASDAQ. Amazon, check this out, guys, just signed its biggest lease ever. Where? New York City, 1.5 million square feet. 1.5 million square feet in New York City. Who would have thought that? I mean, if that's not saying, well, of course, Amazon is doing great in this pandemic. But New York, even for 1.5 million for New York, that's a pretty big contract. The big tech companies, the five, they're really six, but they call them the big five, continue to move forward, and they are beating the benchmark. Amazon up 50, Microsoft, I think I'm off a little screen there, 29%, Apple up 26, Facebook 19, Google up 10. Fair disclaimer, we are in every one of these stocks, in CG and SG, depending on which programs you're in with us. We continue to believe in the recovery and the strength that we are in a secular bull market. I say that every single week, and I actually want to talk about it a little bit in just a couple slides. So 2 of my clients said to me, oh, I saw a shooting star. These are guys that are a little more technical than maybe your average client. Oh, that means it's the end of the rally. So if you look at this, you'll see a black line, and the little dot is at the bottom. What that means is the market hit a high, and then it closed near the low of the day, and then it was followed up by a big sell-off, like 3.5% down since I've seen you last. And I'll say to that, okay, if you want to look in the very, very short term and look at 2 weeks, let's look at this chart. That's the same chart in the whole perspective since March 23rd. Folks, that to me is a bull market recovery. And as you well know from going back to previous episodes, we had the quickest recovery from a bear market to a bull market in history. In history. So, what you see on the screen right now is a chart you guys have seen many times. And I know there's a ton of numbers, but all you really need to care about is blue and red. The red are secular bear markets. Secular, as opposed to cyclical, means over more than one business cycle. Okay, so this was a secular bear market. This is a 100-year chart, 100 years. All right, you can see that we were in a bear market when the market crashed in the Great Depression. And then we were in another cyclical, secular bear market right around the time I graduated high school in the early 70s to 80. And then this huge bull market. And then we entered another secular bear market. You all remember this one. During George Bush's administration, he had 2 bear markets. And if you add all that up, that becomes a secular bear market because it's over more than one business cycle. Okay? But now we have blasted out of this. And if you look at that tiny black line at the very edge of the chart, and I'm taking time on this, guys, because this is so important. That's what happened with COVID-19. That's it. And then there was a huge correction back to the upside from that. Folks, one lesson that is so important about the trade wars and the pandemics is that these challenges are hiccups. These challenges are hiccups. We are within a very strong multi-decade uptrend that began in 2013 when the S&P finally cleared the highs that were throttled in 2000 and 2007. We must constantly remind ourselves of this. Now, you may not believe it yet, but you need to know if you're one of my clients that I believe it. That doesn't mean I'm just going to hold on through thick and thin. If I see a need, I lighten up and go to cash, as I have many times in my career. But right now, it's a positive. What we're hearing is the description of a V correction. So a V, as you can see on the chart, on the left side goes straight down. That's what happened from February 19th through March 23rd. It's the recovery on the other side that no one really knows. We know what it's going to look like. You can see it looks like a V. But everyone's guessing on the time frame. That's the reality. Everyone's guessing. Nobody knows for sure. All right? I think that it's going to be sometime next year, probably at the end of the year, that we're going to be back on track to where we were before this happened. I've got 2 really smart guys here quoting them from Blackstone, which is the world's biggest ETF provider, exchange traded funds. See a big V in terms of the economy. We've already seen the V in the market. Now we need to see the V in the economy. He thinks it's going to be going up for the next few months. Before we get in sync and get back to 2019 levels, it could take a while. Later in his article, he said 2022 late. But Bill Ackman, who is a very famous hedge fund manager who I like a lot, said no, he sees normalization by the second half of 2021. I happen to believe that, and I'm going to show you why here in just a couple slides, okay? So look at the letters up at the top of this. I'm going to show you 6 different historical periods, and we're going to vote at the end of this of which one you think we're likely to repeat. Remember, history repeats itself. There's nothing new except what's been forgotten. And I haven't forgotten any of these because I was alive for all of this, okay? So, scenario A, conflict in the Middle East, the year I graduated from high school. The decline was 24 months. Recovery took 70 months, almost 50% down. All right? Number B, stagflation, 20 months down, 3 months back up. Only went down 27%. Number C, Black Monday. Know exactly where I was when I saw Tom Brokaw come on the news with this. 3 months down, 20 months up. D, the Gulf War, 3 months down, 4 months up. This was pretty shallow. It was technically not even a bear market because it's 19.9. All right? Or E, the tech bubble burst, 31 months down, 56 months to recover, almost half the market value lost. Or F, 17 months down, 49 months to recover in 2007. So because of the time delay, I'm going to wait for just a few moments. You guys vote A, B, C, D, E, F. I'm going to go back real quick and show you which ones they are. And if you get these, you're a genius. I'm impressed. All right, conflict in the Middle East, stagflation, Black Monday, Gulf War, tech bubble bursts, and real estate goes bust. Which one? Who wants to vote? All right, I'm checking the mess. You heard the mattress sales are really up, but no baby boom during the shutdown. Guess they needed a new mattress, yeah. I wouldn't take it laying down for sure. Thanks, Nellie, for that. Martha, people are ready to rock. Yeah, they're ready to spend. Absolutely, with an exclamation point. Charlie, did you see the S&P staying ahead of the Dow? I think that the S&P and the Dow and eventually the Russell, that's going to be an eventually, not this year, will catch up to the NASDAQ. This leadership, Tom, has been pretty consistent. It's NASDAQ, followed by S&P, followed by Dow, followed by Russell. It should be being led by the Russell. Conflict in the Middle East, we got C for Greg. Anybody else? Anybody else? Mark Burns, D, okay. All right. I'm going to wait another second, and then I'm going to give you the answer. And here it is. The answer is C. The most likely scenario is what happened on Black Monday because it was such a radical drop, 33.5%. Actually, the NASDAQ this time dropped 39% in a month. So nothing has been close to this in history. 39% in a month. The recovery, though, trajectory, I think is about right. I think 20 months based on Bill Ackman, based on my own analysis, it's not going to totally be back together this year, but by mid next year, I think we could be back the market well beyond, because the market, as you guys know from episode 1 and probably even before my show, the market is always looking ahead, 6, 9, 12, even 15 months ahead. Okay? All right. Good guesses, guys. Greg got it. Greg got it with a C. So the bull and bear case is going to be a little different this time. We're going to look at sectors. So no individual stocks. But if you're in my CG, let's try that again. If you're in my DG program, which many of you are, you get a cough drop and a sip here of water, so my throat's dry. We're going to look at 3 sectors. Tell me if it's a bull or bear case. All right. Healthcare. The healthcare sector has had incredible bounce back from the lows. The top holdings shows that the technical setups look good. Healthcare sector is putting the V in this recovery. Well, it's the healthcare sector and technology, but there's a bear case to this. Healthcare stocks are among the top performers this year due to COVID-19, but were they top performers heading into COVID-19? Well, I don't know. Despite strong performance, the virus is likely to have negative long-term implications for employer-sponsored healthcare and an increase in operating costs. That would not be good for the hospital stocks that are a part of this sector. And 3 in the bear case, few companies with potential vaccine treatments are likely to profit from their research. I don't really buy that, but we'll see. I will give you guys a moment to put your vote in. Tom is a bull on Bill Ackman, hell is coming, and then makes billions off of the following crash. Yeah, well, he always talks his book, Chris, without a doubt. So, all right, we got some more votes here. Bull bear case, here's the winner. It is a bull. Healthcare is probably a perma buy for 2020, and here's why. All it takes is a few winners for this sector to do very, very well. A few winners on vaccinations, a few winners on testing, anything that can then be systematized and sold worldwide in quantities in the billions. Some companies will win and some will lose, but overall the sector, and the way we like to play the sector, if you look in your accounts, is IBB and XLV. Again, if you're a client, you can cheat on these by looking in your account statements. Okay, let's move on. The second one, the communication sector, should continue to benefit from increasing demand. XLC mostly is large cap communication stocks. Large caps have been the best performers in this recovery. XLC's portfolio of stocks include both high growth technology and traditional telecommunications. So this is the newest of the 11 sectors, and it includes high tech companies as well as traditional companies like T-Mobile and AT&T and Verizon. But what the bear case is that it's often known for its massive combined weight for Facebook and Google. And those stocks account for over 42% of the fund's weight. And as such, they really chart the course for XLC. So if one of those two companies hiccups, that can affect XLC. And then there are those on the bear side that say it's unwise to invest in any sector where two entities control so much of the weight. So what is your vote on XLC? Is it a bull case or bear case? Anyone? And I know there's a delay. I'll give it just another few seconds. And because we're kind of running long, I think I'm going to go ahead and give you the answer on this. We are a buyer in XLC, and the reason that we are a buyer is because mega cap winners are irresistible as long as they remain winners. Don't fade a company just because it's a behemoth. They didn't get to be a behemoth by being badly run, poorly run companies. So yes, XLC is not something, it's not our largest weighted, but if you have the DG program in your portfolio with us, you will find XLC. I see bull, 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 bull. Thomas on the bear. You just heard my reasons, but that's fine. This is what we have this section of the program for you to air your opinions. Now we're going to look at XLU. This is the utility sector. The bullish case on utilities is that they became overbought, driving down the dividend yields, and now they're priced more attractively. Panic selling in March drove down prices and created a better dividend yield when compared to bonds and treasuries. Now, as you know, bonds and treasuries are fixed income. A dividend is what you get when you invest in utilities and other stocks as well. But the point being that utilities compete with fixed income. They're one of the more conservative sectors. While utility stocks may still be in decline, now is a good time to accumulate them. That's the bullish case. But what's the bearish case? Utilities, along with treasury bonds, have been the most hated sector in this bull market. And that's, of course, referring to just the current bull market. Utilities are often labeled as defensive or bond proxies, which I just explained to you. And this characterization leads to an immediate and unwarranted rejection. Okay? During periods of declining growth, utilities are priced at a premium and can be relatively stable because they're highly regulated businesses. Now, I'm hoping these are kind of new facts for you. Maybe you didn't know all of this. Bull? I see Martha talking between Illinois and Michigan there. Okay. All right. Anybody else? Anybody else? This may surprise you guys. May surprise you. This is a bear for me, okay? The dividend rate income benefit, even though it's increasing, is likely dwarfed by the modest to tepid price appreciation. So you can have the greatest dividend in the world from Southern Company or NE or Nextra or ComEd, any of these utilities, but if you're appreciating at a 4% rate, and I can get a 7 to 8 to 12% appreciation or more in other places in the economy that are still relatively safe, that's where I need to be, okay? So, I hope I didn't say it too soon because I see answers are still coming in, but you will not see XLU in your DG portfolios, those of you that are clients. It was there until about 6 weeks ago, and it will be back in there at some time. But right now, we are bearish on XLU. Okay, guys, this is how to reach us. Phone number, office, email, pretty much any way you want to reach us is great. Twitter, you guys, if you don't know, I tweet every day. Okay, so if you're not on my Twitter feed and you want to see what I'm saying, you don't have to wait till Thursday night. All right, just go to Twitter and like me, subscribe at CRPB3. I'm there. Okay. And I always finish with this statement: for we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. We have not been given a spirit of fear. We have never been fearish on this program. We are prudent, but we are going to be encouraged by the good data that we see and the resolve that America is going to recover and recover strongly from this. It's my deeply held belief that we will not only survive this pandemic, but we will survive as a stronger nation. I really appreciate you guys being here. That's our program for tonight. It's Thursday, June 25th. I'm your host, Charles Brown. Please tell your friends. We'd love to have you back here next week. Many of us will not be having 4th of July celebrations this weekend, so we're going to try to have some special fireworks on the program for you, okay? From COVID to clarity, this is CB3 Live.